Welcome back to the Daily Crypto Roundup, where we break down everything happening in the crypto market right now in clear, direct terms, without the noise. Today we're covering 4 major developments that are shaping sentiment across the board. Bitcoin ETF inflows returning while price struggles to move. Ethereum facing renewed downside pressure with some analysts warning of a potential move toward $1,500. Tether winding down its offshore yuan stablecoin. And Zcash sliding sharply as Ethereum moves toward adding stealth address privacy features. This is one of those days where the stories look separate on the surface, but underneath them there's a common thread. Capital is becoming more selective, narratives are shifting, and liquidity is concentrating. Now let's get into the first major story, Bitcoin ETFs. Spot Bitcoin ETFs recorded approximately $88 million in net inflows in the latest session. That breaks a short streak of outflows, and on paper, it sounds bullish. BlackRock's product led the inflows, Fidelity added to it, and that capital flowed directly into physical Bitcoin exposure. But here's the important nuance. Zoom out to the weekly level and flows are still negative. Hundreds of millions have exited across multiple sessions before this inflow. That tells you something critical. Institutional demand is not accelerating aggressively. It's selective. It's cautious, and that caution is visible in the price action. Bitcoin is not reacting as if $88 million is a turning point. It's range-bound. It's digesting supply. There are sellers comfortable unloading around current levels. That's why we're not seeing a clean breakout above recent highs. If ETF inflows were broad and sustained across most products, price would likely respond more decisively. Instead, we're seeing capital rotate into a couple of funds while others remain flat or bleed. This matters because in this cycle, inflows are one of the cleanest sentiment indicators we have. When flows expand across multiple issuers, that means institutions are allocating broadly. When flows concentrate in 1 or 2 funds, it suggests positioning rather than conviction. Right now, it looks like positioning. For traders, that implies range trading remains the dominant structure. Identify support near the mid-60,000 zone. Identify resistance near recent highs. Until flows and price align with sustained momentum, this is a market that grinds rather than runs. Now let's connect that to Ethereum, because Ethereum is facing a more complex set of pressures. Some analysts are now outlining scenarios where Ethereum could drift toward $1,500 if certain risk conditions persist. That's not a guarantee, but it's a serious warning, and the reasoning deserves attention. First, the technical structure. Ethereum has failed to build strong higher highs in recent weeks. Momentum indicators are soft. Key moving averages are being tested rather than defended aggressively. When an asset fails to reclaim strength after multiple attempts, it invites short sellers and discourages momentum buyers. Technical weakness does not cause crashes on its own, but it creates vulnerability. Second, institutional demand is thinning. Ethereum-linked products are not seeing the same inflow consistency as Bitcoin. Derivatives open interest has cooled. That suggests fewer leveraged participants betting on upside continuation. When liquidity dries up in derivatives markets, price moves can become more exaggerated because there's less structural support from large open positions. Third, macro risk appetite is not roaring. Global uncertainty, risk repricing, and cautious positioning across equities tend to spill into crypto. Ethereum, as a higher beta asset relative to Bitcoin, often underperforms in risk-off phases. If capital wants safety inside crypto, it rotates toward Bitcoin. If capital wants safety outside crypto, it exits altogether. Combine those 3, technical fragility, thinner institutional flows, and cautious macro tone, and you have the ingredients for downside pressure. That's how analysts arrive at potential targets like $1,500. It's not emotional, it's structural. Now here's the flip side. Ethereum also sits at the center of the most important technological upgrades in crypto, and one of those upgrades is directly affecting another coin in today's headlines, Zcash. Zcash has dropped sharply from its previous highs, down roughly 2/3 from its peak. Futures open interest has collapsed compared to prior months. Speculative demand has faded. And one of the catalysts being discussed is Ethereum's move towards stealth addresses and expanded zero-knowledge privacy features. Historically, privacy coins like Zcash built their narrative on being unique. They offered shielded transactions. They offered zero-knowledge proof privacy at the base layer. That was their competitive moat. But if Ethereum, the second-largest crypto asset by market cap and the dominant smart contract platform, integrates stealth address functionality, it changes the competitive landscape. Developers might prefer building privacy tools on Ethereum's massive liquidity base instead of a smaller chain. Users might prefer optional privacy features on a network where DeFi, NFTs, stablecoins, and major liquidity pools already exist. If privacy becomes modular and available on the biggest network, smaller privacy-focused coins lose some narrative power. That doesn't mean Zcash technology is irrelevant. It means its differentiation narrows, and markets price narratives. When differentiation narrows, capital reallocates. This is a pattern we've seen before. Layer 1 chains surge when they offer something unique. Then larger ecosystems absorb those features. Liquidity concentrates back to the dominant platforms. It's brutal, but efficient. Now let's pivot to the stablecoin story, because it reinforces the theme of liquidity concentration. Tether has officially halted new minting of its offshore yuan-pegged stablecoin, CNH Tether, and begun a one-year redemption window before fully winding it down. That is not a panic move. It's a product rationalization decision. It never achieved meaningful liquidity or volume. It struggled to gain traction. And in crypto, a stablecoin without liquidity is not stable in a practical sense. It becomes expensive to trade and inefficient to use. Stablecoins thrive when they are deeply integrated into exchanges, DeFi pools, lending markets, and derivatives. USDT dominates because it has scale. USDC holds relevance because it integrates deeply across ecosystems. Non-dollar stablecoins have struggled because crypto trading remains dollar-centric. By winding down, Tether is acknowledging reality. Capital gravitates toward the most liquid units of account. That mirrors what we're seeing with Bitcoin ETF flows. It mirrors what we're seeing with Ethereum absorbing privacy features. Liquidity wins. And this has broader implications. If you are building or investing in niche tokens, you must ask one question. Where is the liquidity going? Because liquidity dictates survival. Right now, liquidity is concentrated in Bitcoin, Ethereum, and major dollar-pegged stablecoins. ETF inflows confirm it. Stablecoin rationalization confirms it. Privacy feature migration confirms it. Let's pause for a moment and talk about positioning. If you are trading actively, this is a market that rewards discipline. Breakouts are failing. Range structures are dominating. Selective inflows are not translating into explosive upside. That means patience matters. Risk management matters more than prediction. And if you are accumulating for the long term, these environments are where conviction is tested. When narratives shift and headlines lean bearish, you either reassess fundamentals or reinforce your thesis, but you do not react emotionally. There's another layer to the Ethereum privacy story that's worth examining. Ethereum integrating stealth addresses isn't just about competition with Zcash. It's about the maturation of zero-knowledge technology across the ecosystem. Zero-knowledge proofs are becoming modular, cheaper, and more integrated. That opens the door for privacy at scale without requiring separate base layer chains. If Ethereum can integrate privacy in a compliant and optional way, it changes regulatory conversations too. Privacy coins have often faced exchange delistings in certain jurisdictions. If privacy becomes a feature inside a major network rather than the defining attribute of a coin, it may alter how regulators approach it. That's speculative, but it's strategically important. Now let's circle back to Bitcoin, because everything in this market ultimately rotates around it. Bitcoin's resilience around the high 60,000 zone, despite mixed ETF flows, tells you something else. Sellers are active, but buyers are not disappearing. There is equilibrium. That equilibrium can resolve upward or downward. The trigger will likely be either sustained inflows across multiple ETF products or a macro catalyst that shifts risk appetite decisively. Watch weekly flow data, not just daily headlines. Watch volume expansion on breakouts. Watch derivatives funding rates for excessive leverage. These indicators will give you earlier signals than price alone. Meanwhile, Ethereum traders should watch two levels: psychological support near $2,000 and structural support near prior accumulation zones. A clean break below major psychological support with rising volume would increase the probability of deeper retracement. A strong reclaim with expanding open interest would invalidate the bearish narrative quickly. Zcash, in contrast, is in narrative defense mode. It needs either a privacy-driven surge in demand or a broader altcoin rally to regain strength. Without those, it remains vulnerable. The next decisive move, whether bullish or bearish, will likely require alignment across flows, macro tone, and technical structure. Until then, expect volatility without trend. Drop your thoughts in the comments, smash like, follow, and as always, we will see you at the top.